G'day there, Wealth Press subscribers, viewers, traders, and investors. It's that time again. It's time for another Friday morning market wrap, and I'm joined, as usual, by Mr. Roger Scott. Roger, how are you today?
Hey, thank you for having me on, James. I'm doing great.
Roger, let's start with the big plunge in the Dow this morning. What brought that on, and what are we supposed to take away from that? Is that something that's going to bleed into next week, or do we just ignore it and carry on?
Well, here's the thing. There's two factors that are driving this down, this little minor correction, or whatever it is you want to call it. Volatility. China is seeing COVID again, and number two, IBM earnings were horrific, and the stock is down quite a bit. So those are the two main factors driving this right now. In terms of IBM's earnings, I mean, that's not here nor there. We're only right now, and I'm going to talk about earnings. I've got plenty of earnings information to discuss today, but we're still too early in the earnings game to make heads or tails out of it. And I think whether we're going to bleed into it next week will have a lot to do with how we close today, which we won't know for several hours. But I think today's closing and seeing how the market reacts to what's going on. It's still too early. Market's only been open for less than an hour. So let's give it some time. Let's see how things go. My fundamental and technicals, everything I'm pointing to is pointing to a much needed correction. And again, I'm not talking about a bear market. I'm not talking about a long, a repeat of what we saw last February. What I'm talking about is a nice, healthy pullback that will shake out the weak hands and allow the stocks to move forward with the right momentum, without being stretched out. And I was talking to one of my coworkers the other day, and we were talking about the advanced decline line. It is narrowing out. We've got divergence between the S&P 500 and the RSI oscillator. We have a percentage of stocks trading above the 200-day moving average at 11-year high right now. So any which way you look at it, and the put to call ratio is below 65 or below 70 as well. So any way you cut it, slice it or dice it, this market is overstretched. So I'm very happy to see what we're seeing right now. I'm hoping it's not going to last or really run into anything major. But if it does, at least for the next 4, 5, 6 days, I wouldn't be surprised.
Yeah, you bet. To what extent do you think this is the market front running the big Fed put in the terms of $1.9 trillion in imminent stimulus?
The stimulus, first of all, every time the government, I don't know if you've noticed or not, but every time the government has announced a stimulus, it's kind of like what happened with interest rates or with the bond market last year, when the Fed was trying to cool everybody off to a meltdown in the stock market. They made 3 announcements. The first announcement had a huge impact on the stock market. The second announcement had medium. And the third one, the market rallied for like a day. So I'm seeing a very similar pattern to that when it comes to the stimulus. The first time, stimulus, wow, huge run. It saved the day, so to speak. The market rallied for a month nonstop. Second time, it was impressive. This now announcement, I think it was more of buy the rumor and sell the fact. It didn't have the impact that most stocks were looking for. I think the bulk of it was already priced into this market, James.
Mm-hmm. Yeah. Do you get the impression that the market is becoming a little bit inured to the effects of stimulus announcements, in that it's like, well, it's like back in 2009 when that first TARP $800 billion thing, toxic asset relief program, that they rolled out immediately following the major crash. The market was blown away by that, and it caused euphoria like we hadn't seen in that entire decade. And so same thing happened with this. This was the first time we actually had a $1 trillion stimulus package back in March. I think it was, what was it, 3.1 trillion in total direct stimulus, and then there was a whole bunch of fiscal stimulus on top of that. That blew the doors off the market, and the market rallied, as you said, for a month after that. But now 1.9 trillion, putting that in that context is not, and maybe the market's, adopted that position where they're saying, well, whatever. Stimulus is now just a regular feature. $1 trillion numbers are now just a regular feature. You're going to have to do more than that to impress the market.
I think it's partly that, and I also think it's partly the fact that the economic condition and what we thought was going to be as a result of a COVID 6 to 8 months ago has not materialized. We are in a much worse condition. We still have 900,000 people applied for unemployment benefits last week. That's new benefits. These are new people. This is telling us that the economy is in a horrific shape. And if it's in a horrific shape here, and if China's getting spikes again, and China has been really careful, China's one of the few economies that had a positive GDP last year. And if China's starting to see spikes, and right now it's seeing it in Beijing, it's not seeing it in some, part of China that's not really here nor there. This is a financial capital of China. So this is much worse than anyone expected a year ago. Much, much worse. The numbers are worse. The relief is not coming. I'm hearing word that Canada is not doing well, that their recovery is going slowly, and people are not going to be getting a vaccine for a substantial amount of time. In America, in our best case, I think Florida, is leading the country right now. My folks, my in-laws just got the shot a week ago, and these people are in, over 65, conditions, this, that. So the point is, healthy people in the workforce are months away from getting the vaccine, and the economy is doing horrific. So, and this is what I was afraid of. I was afraid of this. Think about what the market would be right now without this 1.9 or whatever trillion-dollar stimulus. We are in a bad shape. This reminds me of those beach balls that, everybody's kind of propping it up, and it just keeps moving higher, and it keeps moving higher. And we're just sitting there and hoping, when is it going to start moving higher on its own? And it's not. And it's not. And this is a bad shape. And remember, Biden is a little less optimistic than Trump. He's a little more even. So he's going to give us truer numbers. He's not going to try to snowball this thing or, sugarcoat it. He's going to say the way it is. And he's telling us, folks, things are not doing well. He wants to do this 100-day challenge. There's a lot of things. But financially, the problem is this 100-day window, this 90-day window we're in, this quarter we're in, it's a make it or break it for a lot of companies, where if we don't get out of this mess, and it doesn't look like we're going to, things are going to get a lot worse before they get better. And that's why the market is reacting the way it is.
Yeah. So then with Biden making all of these gestures towards some of the other measures in other countries, talking about travel restrictions, talking about lockdowns, talking about, increase sort of control over population movement to mitigate virus spread, that's not going to help the economy, is it? And
No.
That's going to put more pressure on the Fed for even more stimulus.
That's right. Absolutely. But at the same time,
I'm looking at the plunge in the Dow there and thinking that's just maybe a first shot across the bow from the market, reacting to this idea that, well, the numbers are bad now, but they're nothing compared to where they're going to be by the end of this quarter in terms of the Main Street economy.
It's very possible. I predicted last year that this year we were going to have at least 2 to 3 bumps. Again, we've gone about 6 months of just straight up. We are on a sugar high, James, and we need to correct. But let me comment about your yes, Biden is going to be tough on restrictions, global restrictions. Yes, it's going to put a damper on the economy. But with that said, Biden is also doing a lot of positive things that may add capitalized value to global economy via the solar power, the self-driving cars. We know he's not going to be as tough on China, no matter what he says, no matter how tough he says he's going to be, as Trump. The trade war. So I'm seeing a lot of short-term restrictions that may end up giving a lot more upside for the second part of the year. This may be just part of kind of, swallowing the pill and taking it so that we can move forward. But again, the market is always looking forward. The market is never looking at today. The market is always looking forward. And if we look ahead 2 quarters, 3 quarters, things are, if we can get past this COVID, things are looking good, especially with this money stimulus coming into the country. If you have this stimulus, but you have the COVID running wild, the stimulus is not going to give us good forward-looking picture or forward-looking appreciation of what's going to happen in the future. But if at the same time, we know now that the next 2 quarters is going to give some relief, some stability, the market will start appraising that into its value. So in terms of the U.S. economy, yes, I believe before the end of this year, we're going to have 2 to 3 minor corrections. For sure, not for sure, I can't say for sure, but it's very, very likely, especially with the conditions of the market. But in terms of foreign economy, the foreign economies, global economies kind of taking the negative, the short-term negative with what Biden's doing, but they're also looking ahead, and Democratic president, both houses being Democrat is good for global economy. And I think that may be overriding the short-term negative.
It's interesting. So should we be building in more hedge into our holdings at this point? More defensive positions, like, for example, the directions, triple bear, NASDAQ, pro shares, ultra shares short, SQQQ, or even gold?
Well, gold is not funny. Let's separate that question into 2 separate. It's great questions, but there's 2 separate, very individualized questions there. In terms of in terms of hedging yourself with a direct hedge, a NASDAQ or an S&P or a Dow, that is a direct hedge. If you have if you're holding positions, not swing trading, if you're holding positions, and if you have tax consequences, then it may be smart to hedge your portfolio. The problem with that is you lock in your loss and you completely wash away your profit. It's a zero to zero hedge. Everything you lose here, you gain here. Gold, on the other hand, so I'm not sure that is the best way to do it unless there's tax consequences and you're a long-term trader. I think, and now for the second part of the question, gold is not reacting the way I'm wanting to see it. I'm going to give gold maybe another couple of weeks. And if I'm not, my question is, if it's not going up now, when is it going to go up? That's my question. And remember, there is some correlation with the stock market and gold. So I'm not sure if gold is the answer right now because I'm not seeing any promise from it. I've given it 2 quarters, just not seeing it. It's not giving us that reactive. Maybe because of interest rates, maybe because of the U.S. dollar, maybe because there's a Democrat running the White House. But for one reason or another, gold is not reacting the way I would like it to see. I think a better hedge would be interest rates or a bond market. I think either the TLT or the triple leverage TMF would make a better hedge because if the market does not go down, it's not a direct inverse correlated hedge, which means if the market doesn't go down, there's a chance this hedge will kind of go up with the market. So you may not lose value, but you won't lock in your loss. In other words, you will still have opportunity to gain and have a hedge in case something really, really goes bad. The bond market starts to really react when the S&P falls through the 50-day moving average and starts making its way to the 200-day moving average. It enters what I call the twilight zone, the area between the 50-day and the 200-day moving average. That's when the bond market reacts. So what I would do in this case is I would wait. I would watch the S&P 500 and or the NASDAQ. I would wait for them to get to the 50-day moving average. And once they break the 50-day, once they have 2 days completely trading below the 50-day moving average, I would begin slowly legging into the bond position, either the triple leveraged or the regular non-leveraged one. But that would be the way I would deal with this downside. So that way you don't lock in that way you don't lock yourself out of potentially gaining value.
Right. So then is the risk trade off for now?
Right now, yes. I'd like to see a little more follow through. I'm not satisfied with just seeing one stock over. Look, and I'll tell you why. Overall, the things with COVID can turn. This is just the beginning with China. Things can turn. Things are right now in a position where they can cool off or they can go really bad. I want to see it. I want to wait another couple of days. Number two, so far earnings, we've had 10% of the S&P 500 reports, and the earnings are up about 8% from where we're expecting. And yes, I know the expectations have been beaten to death. But the bottom line is they're still better than expected. And 93% out of those 50 stocks have beaten EPS. So I'm not giving up on that yet. Here is what I would do, James. If I was a trader, I would take some prop. Most people who are in the market right now are sitting on healthy profits. S&P is at all-time highs. NASDAQ is all-time highs. What I would do right now is put some money into cash, take those profits and roll them out of stocks and put them into ETFs. And specifically, I would put them into the same type of ETFs that I have been, propagating for the last several weeks. The evergreen, the renewable energy, the pot stocks, the self-driving cars, mobility, lithium, those type of ETFs, like cars with a ticker symbol K, like lit with a ticker symbol LIT, because you will see those ETFs give us warning signs while stocks are going up. They will still kind of, they tend to lag. They tend to stick to the profits a lot longer than stocks because of their diversification.
Right.
So that's how I would play this game right now. I would be defensive, but not completely defensive. Sure. Because I don't want to put myself in a corner and give away all my potential for opportunity and lock in my loss.
Right. So do you think this rally that has seen us touch new record highs again this week and is looking a little shaky up here, do you think this rally is over and we should be preparing fully for a correction then?
No, I would start preparing for one, but I wouldn't. I think we would be foolish to think that we're at a top right now. It's impossible to predict the top, and I would feel. I think that the fact that Biden is just starting to get into his plan, and we're just starting to see where he's going, I think it's too early. I think the market is going to be on a sugar high for quite some time. So I would be cautiously optimistic right now.
Okay. Great, Roger. We'll leave it there for now. Thanks very much for joining me. We'll come back to you next week at the round table. Have a fantastic weekend.
Thanks for having me on, James.